Welcome, everybody, to the Chinchilla Pickin' Podcast. It is January 22nd, 2022. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and yet again, after 1 month off, I am finally back together with Brandon Beaver. Finally, here we are on the podcast. We actually have not talked whatsoever. We literally got on the computer, worked through our bugs in the system. Brandon hasn't turned on his computer in forever, so we had to work through the bugs, and we're here. So this is our actual first chance to actually talk to each other. We're going to go into stocks, but here, Brandon, how you doing, man?
Can we just give me a second for everybody to congratulate me for being able to operate a 10-year-old computer, and that's what we're doing this on.
What? So yeah, you need to first of all you need to upgrade your computer, but let's skip that for now. I want to explain to everybody why we've been off. I know myself was sick with COVID. My family, there's multiple family members sick with COVID, and then as far as you, I was dealing with that, dealing with a number of other personal issues during that time. And then Brandon, what were you working through during this past couple of weeks as well?
So we went on vacation. We went to Universal Studios, and we came back on December 31st. And at first, the girlfriend got sick with COVID. She was sick for a good 18 days. And then I actually went to work. I was fine. I had no symptoms, nothing like that. And then one day I came back from work, and I jumped in the shower. And I got out of the shower after a hot shower. I was still freezing cold. And I had no symptoms of anything at that time. So, but my girlfriend, Lindsay, she's like, we need to take your temperature because you shouldn't be cold at all. So take my temperature, and it comes in about 102.5 or 102.6 or something like that. And I'm like, that can't be right. I don't have a headache. I don't feel sick. This doesn't make any sense at all. So I'll take my temperature again tomorrow before I go to work. Well, I wake up at 3 o'clock in the morning with a 103.4 fever and heart palpitations, which is scary as hell, by the way, when you have heart palpitations and you have a 103.4 fever. But then if you Google it, it's the craziest thing. And I told my doctor about it too. Heart palpitations with COVID, it's a normal thing. So we're now to the point where they're like, heart palpitations, whatever. It's not a big deal. So I was sick for 12 days. I just got over it. I'm feeling fine now. I went back to work after my quarantine was up, probably about 10 days into it. And the first 2 days back at work were really, really rough. And now I'm at the point where I'm feeling fine. And my voice seems to be back. So, but man, that is rough. That is the worst mild illness I've ever had in my life.
Right. For me, it was a really bad flu. It was really bad. There was a couple of days where I didn't eat, and I was just in pain and shaking. But other than that, it was just flu-like symptoms I just dealt with. But I'm glad we're all over it. Everybody's through those moments and over it and on the other side of it. So that's the good thing there. That's the thing we should be happy about and thankful for.
The bright side of Omicron is that it is mild, and then it seems to be overshadowing Delta. So this mild illness, even though it seemed pretty crazy to me, 103.4 temperature is nothing to sneeze at. And then Lindsay had about the same thing when she was sick too. We were both hot to the touch. Like you could feel our skin hot. It was
I'm told that all the time.
But the but the upside to this is that it's more mild than Delta. It does not attack the lungs the way that Delta does. And if you get Omicron, you're going to get the antibodies to COVID. So this could be I'm not a doctor, obviously. I don't know much about medical, but this could be something that actually winds up vaccinating those of the people that didn't want to get vaccinated. Dave, I lost you on audio.
So there you go, Dr. Beaver giving his opinion on the COVID crisis.
Yeah. And you know what? The thing is when we went on vacation, I'll cover this a little bit in this episode too. We went and I traveled via American Airlines. The airlines were packed. We went down to Universal Studios in Orlando, which was slam packed. And I don't want to down Universal Orlando. Listen, the world has to go on. I get it. I understand it. But there were no social distancing protocols in place whatsoever. They did not limit the amount of people in the park. When you went to a ride, for example, we went on the Fast and Furious ride. They tell you all to pack into a little room. You're shoulder to shoulder with a bunch of strangers you don't even know. So it's not a mystery to me as to how my girlfriend got COVID. It was obvious that it happened down in Orlando, and their hand sanitization stations were almost all empty. So everybody's going around pushing the buttons for the sanitizer and getting their germs all over it, but not actually getting any hand sanitizer. So you're actually passing COVID via your sanitization stations because they're not full.
Yeah. And we'll get into this in the show about supplies and COVID supplies and what's happening because of the Omicron surge. But so actually, let's just get into it then, right? Yeah. I know you don't like fluff. I know you're not a fan of it, and there's a lot of things we want to cover. So let's jump in, man. Rules are that Brandon and I get together 5-10 minutes for the show, and we do not discuss what we're going to talk about. We just tell the other person. However, today we didn't even do that. You're going to hear Brandon. He's going to go first. He's going to bring topics. I have not heard what these topics are. I have no idea what he's going to talk about. It could be the same topics I want to talk about, but we'll go to it and we'll deal with it at that moment. Brandon, take us away, man.
So yeah, as I mentioned, the airlines were full. The airlines, the airports were packed. There were a lot of people there. That, to me, in my mind, it boded very well for the airlines for the holiday season. However, I listened to Delta Airlines conference call. They just recently had an earnings, I think about a week ago, had an earnings report, and they were only at 80% of their passenger levels in December when compared to 2019. So I think what happened was you just didn't have that many airplanes operating. You didn't have that many captains for the airplanes. You didn't have that many flight attendants because there's a shortage of staff right now. And there was
hold up. I mean, so all right, let's circle back, because if you're going to talk about like being at 80% capacity, you brought up a good point about the airplanes, and I want to remind everybody about what happened during the COVID pandemic. COVID pandemic happened. Airlines got shut down to just people who had to fly. You had to have a reason, so on and so forth. And so airlines took that opportunity to get rid of a lot of aging aircraft. So they cut down the size of their fleet. They put in more orders. So Boeing and Airbus were doing really well because they put in more orders for newer aircraft. They were using this opportunity to upgrade their fleets and revamp a lot of things. But like you also said, they did cut a number of staff due to these vaccine mandates. So I think it's more of those issues. I think that they were as full as they could be at this moment in time.
Yeah, and you know what? You mentioned Boeing. We flew on a 737 Air Max. And I got to tell you, I've never had a smoother flight on a narrow body airplane in my life. And I'm not even bullish on Boeing. So my bias was to the negative.
You did have good air. You did have good air. I was checking the turbulence forecast on your flights, man. And because you had brought it up, and I shared with you the website I use. But you did have good air. Everybody was saying it was smooth air the days you're flying, man.
You know what? I've flown a lot, though. Those narrow body aircrafts, usually it's a lot more rocky of a ride. But this time it was not. It was a very pleasant flight to be on. So that was good.
Gotcha.
But 80% to 2019 level. So we're not quite there yet. And then they said 70% for the month of January. And probably for the month of February as well. For January and February, Delta will be operating at a loss. Now, for me, I've mentioned it a million times that this is the best of breed in airlines. So if they're operating at a loss for January and February, I think so is everybody else. And so
why do you think they're operating at a loss? Is it the Omicron? Is that what's causing it?
So they're blaming Omicron. That's what they said in their earnings report in the call. However, one of the most known unknowns here is inflation. Well, you know as well as I do that the first thing that spikes when the dollar devalues is oil. And oil costs have gone up. And I think they're going to continue to go up, especially in the spring. So this is a major headwind for airlines. Inflation.
Yeah, but when do the airlines, like, I know they all sign their hedging contracts at different times. When is Delta signing its hedging contract?
That's a good question. I really don't know. I don't know that. But I can tell you that the airlines it is a very competitive industry, which very competitive industries do not fare well during high inflation times, because they have to keep a cap on their costs, and they have to keep a cap on their on the prices that they're charging people as well. And capping the cost is a very hard thing to do when the price of oil is going up, when the price of new equipment's going up. You talked about the fact that they're ordering new airplanes, all of that, the steel.
Yeah, but that was all paid for in 2020.
Yeah. Well, inflation started to pick up in 2020.
Yeah, no. Well, yeah, here's the thing though. Like, so I don't want to pick holes. I agree with you.
Yeah.
I just want to be open and honest with our listeners here. Is, they paid for those airplanes in 2020. That was agreed upon price. Boom, done, set, deal. Right? And they pay for them up front. It should not be included in what you're talking about now.
Yeah.
Inflation, yes, can hit the airlines because of their profit margins. What you're talking about, like the amount of money the actual net profit they take home for these tickets that they sell, is so tight because it's competitive, and thus, a big jump to inflation like we had can hurt it.
Yeah. And you know what, Delta, we've talked about this in the past. They actually drill for some of their oil. So they're hedged a little bit against it. And it's one of the reasons why I say that Delta is best of breed here. But I'm iffy on it, even though we're trading around, I think it's at a $38 price range. It's $37.71 right now. And I told you in the past that $40 was my level. Anything under 40 at the time I was buying. But right now, with inflation running as hot as it is, and we talked about this, oil is the first thing that spikes during inflation. And they're talking about this is an airplane, fuel, but you're going to go to the gas station, you're going to pay over $4 a gallon probably this spring. The cost of oil in general, not just for us, but for the airlines as well, that's going to go up. And in a very competitive industry that has to compete with, American Airlines, Southwest Airlines, Spirit, all the low cost carriers as well, with price, that is, I think it is going to be the biggest headwind that people aren't talking about right now, because right now everybody's talking about COVID.
Okay. Cost of gasoline, right? You're saying that the oil is going to continue to go higher. However, I have to remind you, the countries like OPEC are not pumping out the oil they were just 10 years ago.
Yeah.
They had drastic cuts in order to keep the price higher, especially during COVID. So did Russia. They have come out and said, look, we're not going to pump more in the market because we need to drive the price higher. So if they start pumping, and that's what they said last year. So this year, if they actually start pumping more into the market, which they have the ability to, we can see prices higher. If the current administration reacts to the inflation and allows those permits that they put on hold last year, they allow them to go through this year, then you can see the price of oil go down. There's many things that could happen to where they could have a immediate direct impact on the price of oil. Yeah. And you could see some savings of gas, but are those things going to happen? I don't know. I know according to the Baker Hughes rig count, which on the last show I did with Nick, I talked about the Baker Hughes rig count, and this is what I watch. It's up from last week. It's up over 40 rigs. It's over 600 again. Pre-COVID, it was at 800 or something. Yes, during 2014, it was like at 1,500, 1,600. So we're still a long way away from those times of oil pumping, but we are still we're putting more rigs out there, so we are pumping more oil in the U.S. now.
Yeah, and I hate to keep quoting a 3 6 Mafia album title, But this is why I said the most known unknowns, because there's a lot of unknowns here. We know what they are, but we really don't know what the effects are going to be because a lot of it is political. The oil situation is political. The situation with COVID is partially political as well. It's medical, but it's also political because if people don't want to ease the restrictions, even after we start to see a decline in Omicron cases, because people are afraid to ease the restrictions and politicians won't do it. So we're in a situation right now with the airlines where I think that there's just a lot of known unknowns. Does that make sense?
It makes perfect sense. So what do? Are you buying on the dips or are you just staying away and watching?
You know what? Jeffries called Delta a buy. Deutsche Bank called Delta a buy. I'm okay with people dipping in under 40. I would prefer 35 if you can get there. But we're in a situation in the market right now where valuation has started to matter. And Delta Airlines, because their earnings have been so depressed, they're still trading at a price to earnings ratio of 86.05, which means that their earnings have to rise to that level to get that price to earnings, because that ratio has to come down. And that's either going to be the price, that's either going to be their earnings rising at a rate to where the price to earnings comes down, or it's going to be the stock dropping. So
it's probably going to be a stock drop, man.
Yeah. And in 2022, now they're saying in 2022, they'll have a meaningful profitability again. But there's a long way to go between now and 2022, even though it's a year.
Yep. 100% agree.
And
let me take over since you talked about airlines. I want to mention a couple of things and get this in, and then back to you. So we'll do it back and forth here. Real quick, guys. The last full podcast we did, and I know it was because of everything that happened, right? It was right before Christmas, and I was talking about a few different things. The calls I made in December, I did not do a good job. It wasn't my, like, all year long, I had been right around the 85-90% percentile being right. Also, December, man, it was hit or miss. I got some right and I got some wrong, and it was a bad month for me on calls. It really was. And I had to reevaluate something. So when you have moments like that, guys, what I've always told people, when this was like when Brandon first started trading years and years ago, I said, man, take 3 days off. Don't watch the markets. Don't do anything. Go play golf, do whatever you do, and just forget about the markets for 3 days and just reset your mind. Because if you don't do that, what you're going to try to do is you're going to try to make those losses up, and you're going to search for something, and you're going to force a bad trade, and you don't want to do that, right? And so since I know this and I'm experienced, I said, all right, Brandon's out, he's sick, I'm sick, we can't even do a podcast right now to save our lives anyways. So I just said, let me just take this time and just relax and get away from the markets. Good thing I did. I had some long-term positions that are now down to actual, like, cooler is down to my actual cost basis when I originally got in, which is ridiculous considering I was up 75% on that stock at one point in time. Actually more, I was up 85%, I believe, when it was at 375. But those long-term positions I'm still holding. I just stayed out of it though, and I didn't do any day trades. The last day trade I called, and it was on the podcast with Nick. I actually know there was that short little podcast I did. I called Tesla, and if you listened to me during that time, you would have made quick little 3 to 5% off Tesla. That was actually one of my good calls. I like that one. If we get time at the end of the show today, I do like Tesla again, and I could explain why if we have time. It doesn't matter, but I do like Tesla again at 943. It's a steal, but rig was one I did call, and it had to do with the oil. And I said, rig is great below 3 right now is what I called that time. So if you guys are still watching rig, I wouldn't buy it right now because I believe there's downside. And this goes to what Brandon says. There's too much we don't know about what's going to happen with oil going forward. And so I would just watch rig, keep it on your watch list, keep APA on your watch list, keep XOM on your watch list, ConocoPhillips on your watch list, all these on your watch list for oil. But, just watch them and wait and see what happens with the price, and wait and see if OPEC and Saudis start pumping out, if Russia starts pumping out. or if the current administration in the United States allows them to have those permits and they can start getting those going. See what happens, because right now with our current rig count, oil is going to stay right where it's at. It's not going to go lower. So our price is going to stay the same. So what Brandon was talking about, cost of doing business for the airlines is going to continue to be high. And that's something to keep in mind, especially during travel season in the summer. Sorry, Brandon, back to you, man. Take it away. What's your next topic you got?
You're kind of going right into what I'm talking about, because in the past month,
Perfect.
since we did our last podcast together, the market machinery has completely changed. Because what has happened is that people started to realize that the Fed's probably going to raise interest rates, I would say at the minimum 4 times this year. It's going to happen. And they've started to pick up the tapering. So what happens when interest rates raise? Valuation comes into play. Things like Netflix dropping 20% after their earnings. That happens. Restoration Hardware, their balance sheet, still incredibly solid. Still a great company. They're like 40% down for the past 3 months. So those price to earnings ratios, they have to come down. So Restoration Hardware, I think not much is really too much has changed with them, but the valuation came into play. Netflix was the same way. It's not like people just woke up one day and said, "Oh, streaming is now competitive." It's been competitive for the past year, but valuation came into play. With Netflix, what it is it was trading at a very high price to earnings ratio, and then it's now in a market in an industry that has matured, and this company has matured too, so it's older. So what they're looking at, they're saying, does your EPS growth justify this price to earnings ratio? And if it doesn't, that price to earnings has to come down, and so the stock has to drop, right? And that's what happened. So if their earnings don't justify that price to earnings ratio, that price to earnings ratio has to come down. The same thing happened with Microsoft, by the way. In 1999, Microsoft was trading at about a 60 PE. Now, over the next 11 years, they tripled their earnings, but their price of the stock dropped about 60% from 1999 to 2010. And that's because valuation matters. And when you start to get into these episodes of the market, where the market machinery starts to change, and if you're not necessarily really a growth stock anymore, then your earnings have to justify that price. So Netflix,
yeah, and it was about 2010 when Microsoft really started pumping out the cloud services. That is their money machine. It literally pumps money for Microsoft and allows them to do other things, such as buy Activision Blizzard this past week. But I mean, Microsoft, like you said, valuation. It wasn't until they had the cloud services take off and start, actually producing money, and that's what made it valuable, and that's what made the price start to rise.
The CEO is a really brilliant guy. He didn't pay really he paid a lot of money for Activision. But when you look at the history of Activision stock price and the market cap, he didn't pay too much for it. He didn't, go and give them too much of a premium on it. So Activision, the acquisition, I'm okay with. It kind of like a lot of people were saying that this sets them up really well for the metaverse, but I'm kind of scratching my head on that. I don't really understand that.
Well, here's the thing with the metaverse and Activision and Microsoft, right? Because Microsoft doesn't have a VR headset in the console in the industry right now. It's PlayStation, it's HTC Vive, and it's Oculus are the 3 leaders. And Oculus is head and shoulders above everybody else as far as spitting out consoles to people, right?
Yeah,
that's the number one way people are involving themselves in VR right now is Oculus, right? So, but Xbox, you guys, what people keep forgetting is the Hollow Fit lens. Xbox makes more money from the Hollow Fit lens than Oculus makes from the Oculus Quest consoles. And the Hollow Fit lens is not on the consumer market. All right, guys. The Hollow Fit lens was a multi-tens of billions of dollar deal for Microsoft with the United States military. They are in the VR. They have developed the technology. They have, quote unquote, a console, a way to be VR inactive with the Hollow Fit lens, but they're using it for commercial and industrial and military grade, and they're not doing consumer.
But it would make more sense to me. I've mentioned this company a lot. Take-Two Interactive. If you've ever played the NBA 2K series, the metaverse is going to be set up around consumers buying things, buying your Nike, hoodies and shirts for your avatar. Take-Two Interactive actually already has this platform in place for NBA. You can get on into an online city. You take your avatar, your player build, whatever you want to call it. You can go into a Nike store. You can go into Adidas store. You can go into a Puma store. You can buy shoes, shirts, all that stuff. And it's a very massive world for an online city for what we have right now for a PlayStation 5 or an Xbox Series X game. It's a very massive world. Take-Two's already got all of that. So for a metaverse, if you're going to buy something for the metaverse, I would say go after Take-Two Interactive. Now, Take-Two Interactive on their own, they just bought Zynga for $11 billion. That one was a head scratcher to me. I didn't understand that acquisition at all. I don't.
Oh,
really
dude, people Candy Crush, man. How many times do people upgrade on that and spend like $1 here, $1 there, and
years
ago, small purchases, huh?
But years ago, though.
Yeah, but you got to think that I just mentioned that as an example, but they have multiple mobile games that people have that they'll spend $1 here, 50 cents there, $1 there, and you think if you have 1 million people spending $1 a day, and you don't have to do any more creation or development, you just got to keep that game moving.
Yeah.
I mean, come on, man. That's a moneymaker, dude. That's why they bought Zynga.
Yeah. Well, I'm still a fan of Take-Two Interactive. And I think
there's a lot of money in these video games. Take-Two Interactive is a great company. Activision Blizzard had great products. Now, what they had was they had sexual assault claims of their senior leadership, which was bringing down the company. And that's why Microsoft saw an opportunity to come in and buy Activision Blizzard at, if they didn't have those sexual assault claims, how much more would Microsoft had to have paid for this company? You got to think of it that way too. Like Microsoft got a deal because of that.
It was a timely buy for them for sure. In my mind.
Now, what's not a good thing as from a business maximizing profit standpoint, I'm not saying it's not a good thing for the employees, was that people came from the quality assurance departments at Raven Software, which is part of Activision Blizzard, and they created a union. So now there's a union in Microsoft. And most companies when they get a union, it takes a hit at their bottom line, their net profits.
So we're talking about all these mergers and acquisitions, and mostly acquisitions.
Yes.
You know what I like a lot better? When a company tells me that they don't have to make an acquisition, and that's Procter & Gamble. This came.
They make acquisitions. I'm going to call you on that. They make acquisitions all the time. Biopharmaceutical companies like out in the middle of Nebraska or Iowa or Kansas or somewhere.
Small. And their director, he spent like 4 years of his life managing these small acquisitions. But they were asked in their recent earnings call, they were asked about any big acquisitions in the future now that they've got their portfolio turned around and that they're doing really well. They said we don't need to. They have enough confidence in their portfolio that they're growing market share in 9 out of 10 of their product categories. So they don't have to make a big acquisition. That means the money that comes in, they don't have to spend your money as an investor on buying another company that's large. And, you're spending $60 billion to buy another company to keep up with everybody else because they're already doing it. Procter & Gamble's earnings per share, they beat. It came out at $1.66 per share versus $1.65 expected. Revenue beat as well, $20.95 billion versus $20.34 billion expected. They're raising prices. I talked about this a couple months ago, and I told you that the price increases at the grocery, they are nowhere near done. Their price increases are going to go through 2022.
All right, so hold up. Let me pause on Procter & Gamble, and let me ask you a couple qualifying questions. Are you a buyer of Microsoft because of the merger?
No.
I am. We disagree.
Okay.
But I'm a buyer on a dip, right?
Okay.
Second question: are you a buyer at Take-Two Interactive right now? at its current price level?
Not at the moment.
All right. I'm not either. That would be on my gamer
We're
type gaming watch list.
We're getting there. We have a price to earnings ratio right now, 34.05. If we can get a price to earnings ratio below 30, I'll buy.
All right. So I just want our listeners to hear us what we're saying and not just talk about these things. Like, are you buying? Are you not buying? And actually make a decision, yes or no. I would buy Microsoft off a dip just because with Activision Blizzard in there, they're going to add it to the Xbox. The Xbox now has a long future, and PlayStation is no longer going to get these games. PlayStation is not going to get Call of Duty. If you want to play Call of Duty, you got to have an Xbox, and that's a good thing for Microsoft.
So we've dipped about 10% on Microsoft in the past month.
Where are we at currently? Because that's not one of the ones I checked today.
296.30.
296?
Yeah.
I'm a buyer. Below 300, and I'm a buyer.
Yeah.
Pre-Activision Blizzard, this Microsoft value, my personal value from Microsoft was over 300. Yeah. Pre-Activision Blizzard. Now with Activision Blizzard underneath it as a company as a whole, it deserves to be higher.
Now, but you know what? Microsoft has plenty of cash on hand, and they'll continue. Microsoft and Apple are two companies right now that I still think will benefit from inflation. As long as we don't have some sort of economic catastrophe happen in the United States, if hyperinflation kicks in and people start going broke and it really, really, really starts burning the consumer, then we'll have an entire, problem across the entire economy. But as of right now, with the devaluation of the dollar, more money being in the system, that's just Apple and Microsoft are just stacking the cash.
Well, I mean, they're not the only ones stacking the cash. Microsoft stacks the cash because of their cloud software business. It takes a relatively low amount of cash to get something like that going. And when I mean relatively low, it does take billions, but Microsoft had billions at that time to create the infrastructure and get it going. But once you get it going, it doesn't take billions every year to keep it going. You know what I mean? And so Microsoft is making money hand over fist off the cloud services.
But with tech, you have to differentiate the companies that have a competitive moat and that are already in a good spot and making a lot of cash. You have to differentiate those versus the tech companies that are growth companies and that haven't proven themselves yet. Those are two different sets of tech, and they'll perform completely differently over the next year, especially with the Federal Reserve raising interest rates. The scenery of the market has completely changed right now, and valuation, like we were just talking about it really does matter. And if a company can stack wads and wads of cash because of inflation and not be in debt, then that's different from a company that's just still trying to build itself up.
So, all right. So here's a company that's still trying to build itself up, but has been profitable last 3 quarters, and that's Tesla. And here's the thing. Tesla has earnings coming out on the 26th, I believe it is. So it's just next week. I believe it's the 26th, maybe the 24th. Don't quote me on that, guys, because I could be wrong. But let's say it's the 26th. Say it's Wednesday, right? Right now it's down to 943 last time I checked. That was from its high of 1100. I'm a buyer. I believe these are people selling, thinking that Tesla's not going to meet the demand, not going to meet their numbers. I believe that Tesla is going to meet their numbers because Elon Musk has been all over the news lately. He has not shied away from publicity. He has not gone quiet. He is still publicly out there. The Tesla has beat consistently, even though they've raised earnings for this earnings forecast. They're going to beat that time. Anytime a company sells off like this, typically before an earnings call, a strong company like Tesla,
that's true.
They usually beat their earnings.
That's true.
They usually beat their earnings.
I'm still not a buyer. And I know you had to bring up my white whale. You had to bring up my white whale, and I am a fan of Elon, and he will beat the numbers. I'm not gonna say he won't. He will. He will sleep on the factory floor to beat his numbers.
Just because you said no on this is another reason for me to buy.
So here's the thing, though. Just like the streaming industry, this market for EVs is becoming incredibly saturated. They're now competing with Ford, they're competing with Chevrolet, they're competing with all kinds of different other manufacturers of electric vehicles. And at some point, they have to justify the price to earnings ratio right now is above 300. So the earnings have to go high enough to bring that price to earnings ratio down, or the price has to come down.
The earnings continue to go higher. And everybody forgets, Brandon, and I keep bringing this up every time I get in this discussion with someone. Everybody forgets back in 2016 when Solar City became a part of Tesla. They keep forgetting that became part of Tesla. So Solar City was a profitable company, right?
Yeah.
Profitable company based out of Texas. It was owned by Elon Musk. He just said, you know what, let's just move that in under Tesla. All of a sudden, Tesla starts beating on their estimates. Why? Because they got Solar City in there, producing profits, pumping cash into the business, but it's all in one big lump sum. So you don't see it broken down as Tesla's profits, Solar City profits. It's all one. And that's why I'm saying Tesla's going to continue to be profits, because they're building cars that are going to be cheaper than Rivian. Rivian's cars are $30,000 to $40,000 more per vehicle.
And they're for soccer moms.
Yes.
The Cybertruck is cool.
It is. But my point is, Tesla is now, because they're the front runners and they've been doing this for so long, they are now able to produce it at a lower cost and thus bring it to the everyday person.
I will give you that. Yeah, for sure. And they will beat their numbers for sure. I'm still not buying stock right now because it's still too high for me, but they will beat the numbers.
So here, all right. So this, I want to cover. I know we're getting close here on our allotted quote unquote time, whatever, what have you. But I do want to say this just because the last comment you made there about, it's still too high for you. I know some people will hear that and they'll think about the stock price and the dollar amount. That's not what Brandon is talking about.
Talking about the price to earnings ratios, the comparisons between the price to books and other companies, even though price to book with Tesla doesn't even really matter that much. But
yeah.
And
that's what Brandon's talking about. And the reason why I bring this up is because people will look at a stock like Tesla and they'll have say they have only $1,000 in their Robinhood or Webull or TD Ameritrade, whatever account brokerage you use, right? And you're like, well, I don't want to buy just one share of Tesla. Well, I'm like, look, if you buy 1,000 shares of $1 stock and it moves 5 cents, you made 5%. But if you buy one share of Tesla stock and it moves 10%, you made 10%. You have to stop looking at things in dollar amounts and start looking at things in percentage gains.
Yeah.
It's all about the percentage gain.
And then also in regards to those metrics. So if you buy a stock that's $1,000 a share, it could still be a cheap stock. You just might be, you got to look at the market capitalization of it, the amount of shares that are out onto the market. If they don't have that many shares out on the market, it's $1,000 stock and it's PE of like 15. That's cheap. You're getting a good deal on a good company, with a low price to earnings ratio at $1,000. And that's cheaper than buying a stock for, $50 and it's got a price to earnings ratio of like 90.
Yep.
So,
yep.
Yeah.
Exactly.
But in regards to this, so what's working right now, Procter & Gamble, they are not a consumer discretionary stock, but what Dave, help me with this right now.
Consumer necessity stock is what I would call it.
That's
because you need detergent, you need dish detergent, you need laundry detergent, you need soap, you need toothpaste, you need all these things in a normal everyday life.
Yeah. So, and they've got a wide enough moat on their brands that people are still going to have to go out and buy these things, even with high inflation, even with the prices going up, right? I don't have to go out and buy a kayak. I can cut that out of my budget if I want to, but I need toothpaste. I need detergent. I need all those things. That's why Procter & Gamble is working. That's why they're able to raise their prices. That's why I still think Procter & Gamble is a buy even after the run that it's had since we profiled them on the show a couple of months ago. But it's also one of the reasons why Netflix isn't working right now, because you can cut your Netflix out of your budget. You can still have Hulu. If you want your Hulu, you want your HBO Max, you can cut Netflix out. You don't need it. But I will say that they are still beating on subscriber growth numbers too. They're just
They lowered their forecasting
lowered their
guidance.
forecast, and that was the biggest problem, and that was why you saw that huge 20% drop. I don't think I've ever seen a mega cap tech company drop that much on earnings.
Not on earnings, but I've seen like Tesla drop like 20% in the day before because of a tweet.
Well, yeah, I've seen that too. That is okay. That's right. But like Netflix doesn't have the kind of volatility that Tesla does. It's still kind of volatile, but it doesn't have the kind of volatility. So that really that shook me when that happened. That it happened all at that. I almost went and bought it. I'm not buying it yet, but it was very tempting because,
you would have made a nice return the very next day.
Human behavior and human emotion plays so much in the market, and people often either overreact to the upside or overreact to the downside. And so since I've been on buying, it's consumer staples, by the way, that's the word. It's been a long week. But consumer staples, since I've been focusing on the consumer staples and I've been focusing on AIG and lower cost financial companies and things like that, Berkshire Hathaway, those have done well in the past month. And now I'm trying to think of what's next, And I do think that there's going to be a heavy reaction to the downside and an overreaction on some of these tech companies. And it probably already has happened. But I'm just waiting. I'm waiting to pick them up. And we haven't had the first of those 4 rate hikes from the Federal Reserve. So I may wait for those to play out first and just see what happens. But I'm looking for a bottom in this market. And this is one of the things that you always need to do. You need to invest for what's next, right? So we've already
but you're never going to find the right bottom. You're never going to find the real bottom. No one ever calls the bottom perfectly. So what you do is you buy incrementally. So, and sorry, I don't mean to cut you off, but I want to cover this with anyone listening. So if you have $1,000 and you know a stock's going to be a good stock and a value stock to own going forward, do it in 3 parts, man. But you take a third of your money, buy it now. If you think and the market goes down, buy another third. And then if it goes down again, buy another third, and just lower your cost basis. And because you're never going to call the bottom exactly. Yeah. You never. I never have. I can't say I never have, but it's been very rare, and it was a very rare, like, whoa, my God, I called the bottom.
Yeah, I love it. It's like hitting the jackpot at the slot machine.
Yeah.
But I had a buddy of mine ask me the other day how much money you should have set aside out of the stocks, and I still recommend having a third. And it's always good to have that money for buying these dips when they happen. One of my biggest rules of thumb, the best way to tell if you're over invested is to just take a step back and think, are you nervous? If you're nervous, you're taking too much risks. That's it. That's it. And then you just take some money out of the market, or, maybe spread it around, diversify a little bit more so that you can sleep at night. But that's it. If you're nervous, you're too much invested. And for rookie investors, for people who are just getting into the market, that may be, no more than 50% to just, when you're just testing things out and when you're just getting used to it. And then for, more experienced investors like us, it could be more. We could have a lot more invested and still sleep at night and be okay with it.
Yeah, I rarely don't have some cash available to buy lower or anything. That hardly ever happens. And in the 15 plus years I've been watching and trading markets, I always try to have at least some cash always on hand, ready to buy lower cost basis, or maybe just to get in on something I saw. Hey, value dip today, boom. You know what I mean? So you're right on that. Always have some cash.
Yeah, and then if you're too nervous, then you're taking on too much risk. Well, in the 1/3, that's not a magic number that I just came up with. That's actually me looking at Berkshire Hathaway's portfolio and seeing that they almost always have 1/3 of their portfolio sitting in cash. So, and I don't know if it's a genius. So if you want to copy that, then I think you're in a good spot.
Yep. All right, man. I say let's start wrapping it up, man. Do you want to do your here? I'll do my final thoughts first. We'll let you get the last word here. Final thoughts from David is Tesla. I think it's a buy, even though Brandon doesn't. But it is Brandon's white whale, so I think that's a good call. Sorry, I have to tease you about that all the time. Other than that, I'm watching Rig, guys. Rig is one I'm watching. I'm waiting for it to drop a little bit lower before I get into it. I am watching the rig counts. It is something I consistently watch. I try to keep a hold of my metrics and research that I watch there. Microsoft below 300. I think it's a good buy, but you're not going to get a big return. I think you're looking at maybe a 5%. I don't think you're going to get a 10% return on it. So I want to be realistic with you. And this is a swing trade, not a day trade. So you're not going to make that back in 1 to 2 days. I just want to make sure I'm clear about that in this podcast before you guys go out and buy Microsoft on Monday. You know what I mean?
Yeah.
But Tesla's the one I am calling. I'm saying, and I'm watching for the earnings. That's going to happen next week. Good call. Brandon, what you got?
You know what? I still like Procter and Gamble dipping into Delta for 2022. I think there's just better ways to put your money to use right now. There's so many stocks right now that have just fallen off a cliff and that have had probably overreactions to the downside that you can get into that would be better than airlines. But if you are going to do an airline, I'm still saying Delta at that point. If you're going to do an airline, valuations matter now. They didn't matter so much the past couple of years, but they matter now. The market machinery has completely changed, and I think that's going to continue throughout this year. I still like insurance companies and financials. The one thing that you need to watch, those you need to make sure that the short-term interest rates on the treasuries don't rise so fast that they start to catch up with the long-term treasuries. You don't want to have what's called a flattening yield curve and be in financials, or even worse, an inverted yield curve. So watch that. It's good that the interest rates are rising for financials, but you don't want the short-term interest rates to overtake the long-term interest rates, because a lot of companies sell those long-term interest rates to pay down their short-term debt. And if that's no longer working anymore, then you have a big problem. So,
yep. And like Brandon said, almost a year ago now, we're coming up on it. Bonds are dead.
Yeah, bonds.
All right, guys. All right. As always, we hope we've been entertaining, educational, uplifting, because we want everyone to make money. You guys have a good night.
Have a good night.